Izin share screen ya. Oke. Oke, apakah udah kelihatan?
Udah, Kak.
Oke, sip. Mulai aja ya. Oke, hi everyone. So today we'll be learning about cost accounting before UAS or after UTS. Now, cost accounting before UAS or after UTS can be divided roughly into 6 major parts. The first one would be joint costs and byproducts. Second one would be cost allocation and support departments. Third is quality costing. Fourth is activity-based costing and activity-based management. And the last one is inventory management, JIT, and simplified costing methods. Now, okay, I'll explain a little bit about the theories for each major parts before going into the problems. Okay, so the first one, joint costs and byproducts. So what exactly is joint cost? Joint cost is cost of a production process that yields multiple products. Now, what does this mean? So in joint costs, we will be able to categorize products into 3 different categories. The first one is main products, which are products with a high sales value. The second one is byproducts, which we will learn also later, which are products with relatively low sales value, and joint products. Joint costs are usually cost of production, which yields joint products. Joint products occurs when both products or those multiple products all has relatively high sales value. Now, in this section, we'll learn more on how the approaches in allocating those joint costs to each products. So the approaches can be divided into 2 broad categories. The first one is physical measures, in which we use comparable physical measures to allocate the joint costs. And the second one is market-based. Market-based can be divided further into 3 methods. The first one is sales value at split off. The second one is net realizable value. And the last one is constant gross margin percentage. Now, that's a little bit about joint costs. Next, we'll be going for byproducts. Now, byproducts are products with relatively low sales value in comparison to the main products. Now, usually we can account for byproducts through 2 different methods. The first one is production method, in which we recognize byproducts in the financial statement, and that the net realizable value of the byproducts are offset against the cost of the main products. The second one is sales method, in which we only recognize the byproducts at sales. However, we recognize the revenue from those byproducts. Now, after the theory, let's get a little bit on the problems. So we'll start with problem 1, which is joint cost allocation. Okay, so the question is, Liverpool sawmill purchased logs from independent timber contractors and processes the logs into 3 types of lumber products. Okay, so we know that this process will lead to us or give us 3 different products, which are studs, decorative piece, and posts used as support braces. Now, these products are the result of a joint sawmill process that involves removal of bark from the logs, cutting the logs into workable size, and then cutting the individual products from the logs. Okay, the joint process results in the following costs of our products for a typical month. Okay, and here we can get the joint cost, total joint cost. Next, product yields and average sales value on a per unit basis from the joint products are as follows. Okay, here we get the output of materials at the split off point or after the joint cost process, and we'll get the information on the fully processed selling price. Now, the studs are sold as rough cutter lumber after emerging from the sawmill operation without further processing by LSAE. Also, the posts require no further processing beyond the split off point. Okay, so an important information is that post requires no further processing. Then we have the decorative pieces must be planned and further sized after emerging from the sawmill. This additional processing costs 90,000 per month and normally results in a loss of 10% of the units entering the process. Okay, without this planning and sizing process, there is still an active intermediate market for the unfinished decorative pieces, which cost selling prices average $55 per unit. All right. So we got all these informations, and the questions here are, based on the information given for Liverpool sawmill, allocate the joint processing cost of 1,010,000 to the 3 products using. All right, so here we are tested for all 3 methods, which is sales value split off, physical measure, and net realizable value. Whereas for the second question is, prepare analysis for Liverpool sawmill that compares processing the decorative pieces further as it currently does, with selling them as a rough cut product immediately as split off. All right, let's tackle the first one. So for the first one, we're asked to allocate the joint processing cost of 1,010,000 using the sales value at split off method. Okay, so how exactly do we do that? Well, first we'll need to find the total sales value of each product at split off. So how do we do that? Well, first we already got the information on the monthly output of materials at split off point. This is the key phrase or key word. Here we have 78,000 stud, 4,000 decorative pieces, and 28,000 units. Now all we need to do is find the selling price at the split off point. Be careful because fully processed selling price does not necessarily mean it occurs at or it is sold after the split off point. So let's find the selling price one by one. The first one is for the post. It can be said here, the post require no further processing beyond the split off point. So we know the fully processed selling price equals to the selling price at or exactly after the split off point for post, which is why here we can see that the selling price per unit for post after the split off point or at the split off is $26 as well. Now, how about for studs? Since studs are sold as rough after emerging from the sawmill operation without further processing as well, so we treat it the same as those posts before, where since it does not go to further processing, we know that this fully processed selling price equals to its selling price at the split off point, which is why we also input $5. However, for the decorative pieces, it is said that the decorative pieces undergo additional processing. So we need to find the selling price before it undergoes additional processing, which is given here. Unfinished decorative pieces in which the selling price averages $55. So we have $55. Now with the monthly unit output after or at split off and the selling price per unit at split off, we'll be able to find the total sales value for each product at split off. So it's just multiply 78,000 times $5, that's 390,000, and so on until we find all of this. Now, after that, we can find the total sales value for all three products. After we find the total sales value for all three products, what we need to do is weight each sales value for each product to the total sales value. In this case, the weighting for studs will be 390,000 divided by 1,338,000, which equals to 29.15%. And we just repeat the process until we got all the weights. Remember, the weighting must equal to 100%. If not, then yeah, it means there's something wrong with the calculations. Now, after we got each weighting, all we need to do is just multiply the weight to the total joint cost, which is 1,010,000. So here we get 29.15% times 1,010,000, and so on. And we will get the answers for question 1A. Yeah, okay, there we go. Now, the next one is physical measure method, and it's specified volume in units. Okay, so technically the approach in doing this is similar. However, the difference is in the basis of the weighting. Here, the basis of our weighting is total sales value at split off. However, in the physical measure, the weighting is based on the physical measure we use. In this case, it says that, or it is stated that we should use volume in units. Here we already get the monthly unit outputs or the monthly units. So all we need to do is just find the weighting for each product based on the monthly units output. In this case, let's say studs has a total of 78,000. And then we just need to divide it with the total units produced from all three products, which is 110,000. And we will find the weighting for the studs. And we repeat the same process for decorative pieces and posts as well. Then once again, once we found the weighting, all we need to do is just divide the total joint cost, multiply the total joint cost with the weighting of each product. And then we'll find the joint cost allocated to each product. And so if we do that, this will be the answer. As you can see, 716,182 equals to 71% multiplied by 1,010,000. All right. So that's for the physical measure method. It's pretty straightforward. Next is for the net realizable value method. So for the net realizable value method, we use relative NRV as the basis for the weighting. NRV means, or the formula for NRV is simply final sales value minus separatable cost. NRV equals to final sales value minus separable cost. Right. So when it says final sales value, this means that we need to use the selling price after it is fully processed. Now, since studs and posts is already fully processed and split off, once again, we just need to use this selling price. However, decorative piece is further processed after split off, and it will have a selling price of 85, as shown in the question. Here we go. Now, after getting the monthly units and the fully processed selling price, we'll be able to find the final sales value. Just multiply 78,000 times 5. And then once we have the final sales value, all we need to do is minus it by the separable cost. In this case, studs and posts do not have separable costs because they are not further processed, right? Which is why there's no minus here. However, decorative pieces are indeed further processed and it has the separable cost, which is provided by the question here, which is 90,000 per month. So all we need to do is 3,600 times by 85 minus by 90,000, which we will get $216,000. Now, after we got all the net realizable value, we just sum it up. And once again, all we need to do is calculate the weighting. Simply, let's say, for example, studs is 390,000 net realizable value. We just divide it by the total net realizable value of all the joint products on the joint process. Then we'll get 29.24%. We just repeat the process until we get all the weighting. Then once we have the weighting, all we need to do is multiply the weighting by the total joint cost, which is 1,010,000. And we'll get the answers here, joint cost allocated to each products. Okay, that's for the first question. So the only difference in these methods are just the basis on the weightings. For example, sales value at split off means that sales value at split off will be the basis for the weightings on calculating the joint cost allocated. And same goes for the rest. Okay. Next one is number 2. Prepare an analysis for Liverpool sawmill that compares processing the decorative pieces further as it currently does, with selling them as a rough cut product immediately at split off. Okay. So this question practically asks us whether it's profitable or not to further process the decorative pieces. So to answer these types of questions, simply we usually just need to use marginal revenue and marginal costs. Okay, so first we need to find the monthly unit output, which is 4,000 there. And then remember in the question, once it is further processed, it loses 10% of the output. Here, result in loss of 10% of units entering the process. So we know that at the end, after further processing, the units sold or available for sale is 3,600 only, where its final sales value will be 306,000. Here we go. Now, to find out the incremental or marginal revenue, we need to reduce or minus the final sales value after further processing with the sales value at split off or without further processing. So we find that if we further process this decorative piece, we'll get an incremental value, or we'll get $180,000 more in revenue. Now, all we need to do after finding this is minus it by the separable cost, or in this case, the marginal cost, which is, as mentioned in the problem, 90,000 per month. So 108,000 minus 90,000, 18,000. So we know that with further processing, we'll get 18,000 more in profit. Okay. Right. So that answers number 2. if they're asked the decision, then the decision is to further process the decorative piece. It gives a marginal contribution of $18,000. All right, that's that's for joint cost. Next, we'll go for byproducts. All right, so problem 2, byproducts. The Seattle Recycling Company purchases old water and soda bottles and recycles them to produce plastic covers for outdoor furniture. The company processes the bottles in a special piece of equipment that first melts, then reforms the plastic into large sheets that are cut to size. The edges from the cut pieces are sold for use as package filler. Okay, so here's the key phrase. The filler is considered a byproduct. So unlike before, which are considered joint products, here we have a byproduct because the filler has a relatively low sales value in comparison to the other products. Here it says RCC can produce 25 table covers, 75 chair covers, and 5 pounds of package filler from 100 pounds of bottle. So this is the conversion rate here. Now in June, SRC had no beginning inventory, purchased and processed 120,000 pounds of bottles at a cost of $600,000. Then SRC sold 25,000 table covers, 80,000 chair covers, and 5,000 pounds of package fillers. All right, so here are the questions. Assume that SRC allocates joint cost to table and chair covers using the sales value at split-off method. Okay, and accounts for the byproduct using the production method. All right, what is the ending inventory cost for each product and gross margin for SRC? All right, so let's just go first here. Once again, we're asked to find the sales value or to allocate joint cost using the sales value at split-off method. So all we need to do is practically repeat the same thing that we did before. Here, I already calculate the sales value at split-off, which is just 30,000 times $12 for table covers and 90,000 times $8 for chair covers. Then after this, we just need to total them up and then make the weighting based on this sales value. Then once you make the weighting, all we need to do is just multiply the joint cost with the weighting. Now, okay, one thing to note here is that since we have a byproduct and we are using the production method to account for this byproduct, the net realizable value of the byproduct will be deducted or will decrease the total joint cost allocated. Now, in this case, at first, the total joint cost is 600,000. But we know that the byproduct can have a net realizable value of $6,000. $6,000 from here. 120,000 pounds means if we convert it into package fillers, means we'll get 6,000 package fillers. Now, as each package filler is sold at $1 per pound, that means we know that the net realizable value of the whole amount of package filler will be $6,000. Then once we reduce it to the joint cost, we have this joint cost allocated or joint cost yang akan dialokasikan. Then we multiply it with the weighting and we'll have joint cost allocated for 2 of the joint products or main products, which is 198,000 and 396,000. Okay, now is the next question. Assume that SRC allocates joint cost to table and chair covers using the sales value split-off method and accounts for the byproduct using sales method. Okay, so this is practically the same question. Oh wait, sorry, we have not find the gross margin. Right, so the question asks for us to find the ending inventory cost for each product and the gross margin. So easy enough, gross margin is literally just revenue minus cost of goods sold. So all we need to do is find the revenues or the amount sold, which is provided here. 25,000 times 12 and 80,000 times $8, which we'll get here 640,000 and 300,000. And then we'll need to find the cost of goods sold. Now the cost of goods sold, as there are no separable costs here, is simply just the joint cost allocated minus the ending inventory. So as we already found the joint cost allocated here, we just need to drag it out here. Then we'll need to find the ending inventory. The simplest way to find the ending inventory is just the amount produced minus the amount sold times by the selling price or by the cost, sorry. In this case, we sold 25,000 table covers, but we produced 25 times 25 times 120 table covers. Here, there's table. Okay, in this case, we manufactured 30,000 table covers, but we only sold 25,000. So we have 5,000 units left, right? Then all we need to do is to find the ending inventory cost. Now, the ending inventory cost is simply the joint cost allocated multiplied by the ratio of ending inventory to the products manufactured, or in this case, 5,000 divided by 30,000, or 1 out of 6. So 198,000 divided by 6 or multiplied by 1 out of 6, as shown here, will be 33,000. And we just need to do the same thing for chair covers. Then once we do that, we'll be able to find the cost of goods sold. And once we find the cost of goods sold, all we need to do is just deduct the revenues with the cost of goods sold, and we'll find the gross margin. And we'll be able to answer question 1, which is the ending inventory cost here and the gross margin here. Okay. Now question 2. Now question 2 is practically the same here. What is the ending inventory cost for each product and gross margin, except that it uses sales method. Okay, so what's the difference between production method and sales method? In sales method, we do not deduct joint costs with the naturalizable value of the byproduct. So in this case, the joint cost stays 600,000 as we use the sales method to account for byproducts. So once again, we just need to repeat the process we did before. We find the same weighting, of course, and we allocate it to the total joint cost, which this time, if we use sales method, is 600,000. So table covers will be allocated 200,000 and chair covers will be allocated 400,000. Okay, now this time we also need to calculate once again the gross margin and ending inventory costs. Now for the joint cost allocated, we do the same process again. Just drag this down, and for the ending inventory, we also do the same process. In this case, 200,000 divided by 6 or multiplied by the ratio of 1 out of 6 to get 33,333. Whereas we also do the same thing for chair covers. And once we deduct joint cost allocated with ending inventory, we'll be able to find cost of goods sold. In that respect, it's literally the same. Now, the difference between the production method and sales method, aside from not reducing joint cost by its net realizable value, is that in the sales method, the sales of the byproducts, or in this case, package fillers, are recognized as revenues. In this case, we sold 5,000 here, shown, with cost or selling price of $1. So we acknowledge a revenue of $5,000, which will be included in the total gross margin here. Okay, so that's practically it for number 2. Remember the difference between the production method and sales method is that in production method, the total joint cost allocated is reduced by the NRV of byproduct here. While in sales method, the joint cost is not reduced. However, we recognize the sales of byproducts as revenue. Whereas in production cost, we do not recognize the sales of the byproducts as revenue. Okay, next will be problem 3. Discuss the difference between the 2 methods of accounting for byproducts, focusing on what conditions are necessary to use each method. Okay, the difference is the one I showed before, and this is a little bit theoretical, so I'll just read it here. The production method of accounting for the byproducts is appropriate if the company is positive that they can sell the byproduct at the expected selling price. So what this means that the production method tends to be used only when we can predict or when we are sure that the expected selling price will be the actual selling price. However, the sales method is more appropriate when we are unsure or the selling price of the byproducts is unknown, or if this is immaterial or negligible, or if the byproduct is not material and negligible. Okay, so that's a little bit on when to use the production method or the sales method. Now let's go to the next one, problem 2b. Here, the accountant for SRC needs to record the information about the joint and byproducts in the general journal, but is not sure what the entry should be. The company has hired you as a consultant to help its accountant. Okay, first one, show journal entry at the time of production and at the time of sale. Okay, so we need to account for both time of production, time of sale, assuming that this accounts or we account the byproduct using the production method. Okay, so just go straight to the journal. All right, so in the production method, we acknowledge the byproducts during the production, right? So in this case, we do have journals for byproducts at the type of production. So what exactly is it? Right, so the first one is a general journal, since we allocate 600,000 from accounts payable to WIP inventory or work in process inventory. Next, for the byproducts itself, as I mentioned, since it reduces the joint cost allocated, we can acknowledge byproducts at the time of production by reducing the work in process inventory and allocating it to the finished goods inventory of its own classification, or yeah, this is the byproduct. Now we allocate this by the net realizable value amount, which is 6,000 as mentioned before. Now, how does this affect the allocation of joint products? Now, as we can see here, for the joint products, the journal we make is once again just debit finished goods inventory based on each main product and credit work in process inventory. In this case, the joint cost allocated is only 594,000, as we have already allocated 6,000 or used 6,000 to acknowledge the byproduct. So why this only 594,000? Then we allocate it here. Now that's during the time of production. Next, during the time of sales, unlike sales method, production method does not acknowledge revenue when we sell the byproduct. So in this case, if we do sell the byproduct, all we need to do is debit cash or accounts receivable, and instead of acknowledging revenue, all we need to do is just decrease the finished goods inventory for the byproduct or credit, which is 5,000, because only 5,000 is sold in this case. Whereas for joint products, we just do a normal journal, debit cash or AR, and we acknowledge sales revenue here. Okay, and since we acknowledge cost of goods sold, same thing or same principle as normal accounting. We just debit cost of goods sold for each product, and we credit it with the finished goods inventory. Okay, now for the next one, show journal entries. Once again, the same question. At time of production and at time of sale, assuming SRC accounts for the byproduct using the sales method. Okay, however, here we journalize this based on the sales method. Okay, so unlike the production method, when we acknowledge byproducts using the sales method, it means that we don't acknowledge the byproducts during time of production. So as we can see here, for the first general entry, it's practically the same as the production method, in which we debit WIP inventory and credit accounts payable. However, as we don't recognize byproducts during its production or during the time of production, all we need to do is just don't post any entries for during or for the byproducts. Here, no entry. Whereas for the joint products, once again, we allocated in a similar fashion. The only difference here is that we allocate the total joint cost of 600,000. Unlike before, which is 594, since we reduce it with the net realizable value of the byproducts in the production method. Now, however, using sales method, we acknowledge sales revenue for the byproducts. Okay. In this case, when we sell the byproduct, we debit cash or AR, and we instantly credit sales revenue with the byproduct. By the amount sold, of course, which is 5,000, 5,000. And for the sales of the joint products, it's practically the same thing as the one before, or as the production method, where we just debit cash or AR and we credit sales revenue. Then for the cost of goods sold, or when acknowledging cost of goods sold, is still the same principle. We debit cost of goods sold and we credit finished goods inventory. However, this time the allocation or the amount is different because we allocate a total of 600,000 joint costs in comparison to the production method, which only allocate 594,000. All right, so that's practically for joint costs and byproducts. If there are any questions, feel free to interrupt me. Okay, but I'll be going to the next section or the next part. All right, so after joint costs and byproducts, we will learn about cost allocation and support departments. So cost allocation is like its name. It's literally just us or our approaches in allocating cost to the cost objects. Now, in this case, or in the context of what we're learning, we will have to differentiate two types of departments. The first one is support departments, which is the department which provides services to assist other internal departments. And the second one, or the main one, is operating department, which is practically a department which directly adds value to the product or service we are producing. Now, in cost allocation itself, if we are only allocating the cost of one support department, we have two methods to do so, which is the single rate and the double rate. So the difference is that in a single rate, we do not distinguish fixed and variable costs. So we clump up all the costs into one, and we calculate a rate for the total cost. However, in double rate, we distinguish between fixed and variable costs. Now, however, if we need to allocate costs from multiple support departments, we will have three different methods, or at least in the book, we will have three different methods to use from. The first one is direct method. Direct method means that we just instantly or directly allocate costs from the support departments to operating departments only. Sorry. So in the direct method, we do not allocate costs from one supporting department to another supporting department, but we just allocate the costs incurred for the supporting department to the operating departments only. Then next we'll have step down. In the step down, we allocate costs to other support departments and operating departments in a sequential manner. It'll be easier to show it in the problem or once we see it in practice. So that's first step down. Next is reciprocal. In reciprocal, we allocate the cost of support of the supporting department to other supporting and operating departments. In this case, in the reciprocal method, we fully recognize the mutual services provided between the supporting departments. We will see the difference between the three later. Now, after that, we'll also learn about common costs. Common cost is practically cost of something which is shared. Now, in allocating or distributing common costs, we'll have three different methods. Standalone method is the weighting, or we use the weighting of each product's standalone prices as the basis of allocating the common cost. Next, we have incremental, in which we allocate most of the common cost to the primary object first, and then to the incremental object or the non-primary object. And the third one is the Shapley method, which is practically finding or using the average when both objects, or in both scenarios where the objects are both the primary and incremental party, and then using that as the basis to allocate common costs. Okay, that's a little bit about the theory for cost allocation. So let's just start into the problem or get into the problem. Okay, so this is the support department. Problem 3. The Martinez company has two products. Product 1 is manufactured entirely in department X. Product 2 is manufactured entirely in department Y. Okay, to produce these two products, the Martinez has two support departments. Okay, so we know that the two support departments in this case is A and B here. Whereas X and Y are operating departments. Why? Because they directly add value to the product, which in this case is product 1 and product 2. Okay, and here we are given an analysis of the work done by departments A and B in typical period follows. Okay, so in this case, we know that the units used or the work done used by department B for department A or using department A is 200, whereas department X uses 500 units of work done from department A, and so on. The same thing applies to the one below here, which means in this case, A uses 750 units of work done from B. So X uses 125 units of work done from B, and so on. Now, The work done in Department A is measured by the direct labor hours of materials handling time, whereas the work done in Department B is measured by kilowatt hours of power. Okay, the budgeted cost of the support departments for the coming year are as follows. Okay, so here we are given the budgeted total cost of Department A and Department B. In this case, Department A has a total of 210,000 plus the power cost or the cost from Department B, which is not yet allocated, which we will do later. And Department B has a total cost of 90,000 plus the material handling cost or cost from Department A, which we will allocate later. Okay. Next year, the budgeted cost of the operating departments for the coming year are 1,250,000 for Department X and $950,000 for Department Y. Okay. Supervision costs or salary costs. Depreciation in Department B straight line of power generation equipment in its 19th year of an estimate 25-year useful life. It is old but well-maintained equipment. Okay. So here are the question, or here's the question. What are the allocation of costs of support departments A and B to operating department X and Y using the direct method, the step-down method, in which we allocate department A first. Then third is the step-down method, but we allocate department B first. And the last one is reciprocal. Okay, we'll go through them one by one. Okay, so the first one is the direct method. Okay, this problem. Right. Okay. Sorry. Right. So once again, in the direct method, all we need to do is just directly allocate the cost of the supporting department to the operating departments. In this case, what do we mean? It means that we don't recognize the work done used by other supporting departments. In this case, although B uses work done from supporting department A, we don't recognize this in the direct method. So all we need to do is just directly allocate the 210,000 and 90,000 we have to X and Y. Okay, in this case, X uses 500 work done of A, while Y uses 300 work done of A, which means we know that the total work done used by both operating departments for A is 800. Now all we need to do once again is to make the weighting. In this case, this is X is Y. Sorry, this total, which is 800. In this case, if we only consider these two operating departments, X will have a weighting of 500 divided by 800, right? Whereas Y will have a weighting of whatever left from this, which is 0.375. So all we need to do is just multiply this weighting with the cost to allocate from department A. In this case, 210,000 times by 0.625. Here we go, which we will get 131,250. Same thing for Y. We just need to multiply 90,000 by 37.5%, which will get 78,750. Now, the same thing applies to department B, where all we need to do is just find the weighting used by operating department X and Y from the work done supplied by department B. In this case, they all have a total of 500, right? Then we need to find the weighting if we only consider these two operating departments. 125 to 500, 25% and 75%. Here. Now, once again, once we find the weightings here, we just need to multiply it by the total cost to allocate. In this case, department B has 90,000 cost to allocate. So 0.25 times 90,000 is 22,500, and 75% times 90,000 is 67,500. Then after we sum them up, we'll get the total costs allocated to each operating departments. So this is the answer if we use the direct method. Okay, so this is the direct method. Next, we're asked to use the step-down method in which we allocate department A first. Okay. So in the step-down method, we only prioritize the allocation cost to another supporting department of one supporting department only, as we'll see here, for example. And here, in the step-down method, since we are asked to allocate department A first, that means we need to allocate the cost from department A first. In this case, since this is step-down, we acknowledge the work done used by department B from department A. So in this case, department A has a total cost of 210,000. Now, unlike before, we can just use the normal weightings here when we add up all the units of work done by B, X, and Y. So unlike direct method, we acknowledge B here this time. So 20% multiplied by 210,000 will get 42,000. Then here for X is 50% used. So 210,000 times by 50%. And so on. So this will be the cost allocation from department A to other departments here. Now, what we do after this is we need to add the cost to allocate from department B with the new cost allocated. In this case, as you can see, since B is allocated 42,000 costs from department A, we just add 90,000 with 42,000 to get 132,000. Now, but however, in the step-down method, the cost from department B is not allocated to department A, since this time we prioritize department A only in the step-down method. So what we do is the 132,000, we just need to instantly allocate to the two operating departments only. In this case, they will have a weighting of 25% and 75% right here. So 132 times by 25% will get 33,000. Whereas 132,000 times by 75% will get 99,000. So once we get all this, we'll have the total cost for X and Y here. So this is the step-down method if we allocate A first. However, question 3 states that we are required to make the answer or to find the answer using the step-down method if we allocate department B first. Now, if we are asked to do that, in this case, we allocate the cost from department B to department A, to supporting department A. However, we won't allocate the cost from department A to department B. So it's practically a reverse of before, whereas before we allocate the cost from department A to department B, X, and Y. However, we don't allocate B to A. However, now in this case, if we allocate B first, we allocate the cost of B to A, X, and Y, but we don't allocate the cost from A to B. Okay, so in this case, simply use the normal weighting here, which is 60% for A, 10% for X, and 30% for Y. So easy enough. The total cost to allocate from department B, we multiply it by the weightings here. So 60% times by 90,000, we get 54,000. And then 10% times by 90,000, we'll get 9,000. And 30% multiplied by 90,000, we get 27,000. Then once again, since we allocate some of the costs from department B to department A, we need to acknowledge this new cost allocated. So we just add this 54,000 to the initial 210,000 incurred from department A. So we know that we have 264,000 costs to allocate from department A. Then easy enough, we allocate this 264,000 to only the operating departments, which is X and Y. Now what we need to do here is use the weighting before, or use the weighting in which there's only X and Y, or in which we only acknowledge X and Y. So here is 62.5% multiplied by 264,000, we'll get 165,000. Whereas this is, here we go before, 37.5% multiplied by 264,000, and we'll get 99,000. And we'll get the answers here. Okay, so that's for the step-down method. Next is the reciprocal method. So the reciprocal method is similar to step-down method. However, it differs in which we fully recognize both support departments' contribution to each other. So unlike the step-down method, in the reciprocal method, we'll keep recognizing or we'll keep allocating these costs to the support departments as well. We can see it here. So here, this will be the answer. This is a bit long indeed. Reciprocal method is a bit long. So as you can see here, first we have 210,000 and 90,000, right? So in this case, in the first row, we allocate the 210,000 from the support department A to all the departments, which is B, X, and Y. So this is practically similar to step down at first here. As you can see from before here, it's similar to this part first. However, unlike the step down method, we allocate it again, or we allocate the cost from B again to A as well. So in this case, B has 132,000 to allocate, right? However, unlike step down method, this time we still recognize support department A. So we allocate 132,000 to support the department A, X, and Y. Now, however, after we acknowledge or after we allocate this again, that means we know that A still have cost to allocate again, right? So we allocate the cost which we get before again to B, X, and Y. And then since B has cost to be allocated again, we reallocate it again to A, X, and Y. And we just rinse and repeat the process until we'll get 0 from each support departments. In this case, X and Y will have a total of 165,000 and 135,000. So this is the manual way of doing reciprocal method. Yeah, so simply we just keep throwing it back and forth. So support department B, we allocate to A, X, and Y. And then after we know that we've allocated some to A, we allocate the remainder from A to B, X, and Y. Then since we've allocated some cost to B again, we allocate it again to A, X, and Y, and so on. However, a simpler method to find the total cost is to use a formula or equation. In this case, the equation usually consists of supporting department 1, let's say, equals to X, which is the base cost of that supporting department, plus B, which is the weight, the weight of that supporting department in its allocation of work done, times by SD2, times by the cost of supporting department 2. Okay. Or this is, in this case, the formula will be like this. Department A equals to 210,000, which is the base cost for department A, as we can see here, 210,000, multiplied by 0.6. 0.6, as we can see, is the weighting or the work done used by A from B, or supplied by B here, 60%, multiplied by the cost of supporting department B. And the same goes for department B. Now, all we need to do is just substitute this equation here, and we'll get this answer here. So if we substitute this equation B to equation A here, we'll be able to get that A has an equal or a value of 300,000. Now, after we find the value of A, we just need to input A to the second formula, and we'll get the value of B. Now, what do we do after we find this cost to be allocated here? So once you find this formula, all we need to do is just allocate this cost to the operating departments. In this case, we have A, 300,000, and B, 150,000. Since we already get the total here to be allocated, all we need to do is just allocate this to the operating department. In this case, we use the formula or the weighting before, in which X is 0.625 here. 50,000. Oh, sorry. What? I'm 50%. Sorry. 150,000. Oh, sorry. 300,000 times 50%, which is 150,000. Whereas Y is, as we can see here, is 30%. So 30% times by 300,000, and we'll get 90,000. Then same goes for B. All we need to do is just allocate this to X and Y based on the normal weightings. So 150,000 times by 10%, since X uses 10% of work done from B, just 15,000, and 30% times by 150,000 to get Y. And then we both sum it up and we'll get the answers as well. So as you can see, this method gets the same answer or an equivalent answer to the one before. All right, so that's practically cost allocation. So just remember the difference in a direct method, step down, and reciprocal is how much we acknowledge the supporting department's role in providing other supporting departments. So in this case, in the direct method, we don't acknowledge the role of supporting departments to other supporting departments. If in step down, we acknowledge some of it or a partial of it, whereas in reciprocal, we acknowledge the whole thing, or we acknowledge it fully. Okay, so that's for cost allocation. So we'll be going to the next section, which is activity-based costing and activity-based management. Okay, so we'll go to activity-based costing. Now, before we learn about what exactly is activity-based costing, we will need to know the definition of simple costing. So simple costing is just practically a costing method in which we only use a few indirect cost pools or rate. That's simple costing. So what exactly happens when we use simple costing? Usually, if we use simple costing, it leads to broad averaging. Broad averaging leads to products easily being over or under costed. Now, that's why to make or give more accurate information, people or experts have made refined costing. Refined costing, what's the difference between refined costing and simple costing? In refined costing, we try to identify as many indirect cost pools as we can. So that's the difference between refined costing and simple costing. Now, activity-based costing, which we will learn, or which we learn here, is a type of refined costing in which we identify individual activities as a fundamental cost objects, or as a fundamental basis for allocating the indirect costs. Okay, so this is a little bit theoretical. However, in implementing activity-based costing, we will need to do 7 steps here. The first is to identify the products chosen as cost objects. The second is to identify direct costs. The third is to select activities and cost allocation basis for indirect costs. The fourth is to identify the indirect costs associated. The fifth is to compute rate per unit of each cost allocation method. The sixth is to compute indirect cost allocated. And the last one is to compute the total cost. Okay, so usually, what are the benefits and costs of activity-based costing? Well, as mentioned, activity-based costing is usually more detailed and accurate. However, the cost it's more complex and more costly to implement. Okay, so that's practically the essence of activity-based costing. So activity-based costing is just practically simple costing. However, we divide the indirect cost rates into more specific indirect cost pools. In this case, if we see the question here, we'll see that we divided into many cost drivers compared to only one cost driver if we use simple costing. Okay. Now, related to activity-based costing, we'll learn about activity-based management. Now, activity-based management is practically somewhat intuitive, in which activity-based management is the method that uses activity-based costing information to improve customer satisfaction and profitability. So in essence, usually what we are asked to do in activity-based management is to compare the results we get using simple costing in comparison to the results we get from activity-based costing. And then by comparing those results, we give management recommendations and specific, let's say, guidelines or maybe things to point out. So that's practically activity-based management. Okay, so let's just get right into the problem here. The first one is activity-based costing problem 4. Pharma Health Inc., a distributor of special pharmaceutical products, operates at capacity and has 3 main market segments. Okay, so we are given 3 main market segments here. Then Rick Flair, the new controller of Pharma Health, reported the following data for 2017. Sorry. Okay, so we get the following data here. We know the revenues, cost of goods sold, and we know the gross margin. And we know the total operating or total other operating costs. However, it's not specified the other operating costs for each market segments, or it's not allocated yet. Okay, so for many years, PharmaHelp has used gross margin percentage, okay, to evaluate the relative profitability of its market segments. Okay, so it's a key phrase which we will use later. But Flair recently attended a seminar on activity-based costing and is considering using it at PharmaHelp to analyze and allocate other operating costs. Okay, so he meets with all key managers and several office operations and sales staff, and they agree that there are 5 key activities that drive other operating costs at PharmaHelp. Okay, so in this case, Flair here wants to use activity-based costing to allocate this other operating costs to each market segments. In this case, we are given a few activity areas and cost driver to calculate the other operating costs. Just order processing. So order processing has a cost driver of customer purchase orders. Line item processing has a cost driver of number of line items. Okay, and then delivery to stores has a cost driver of number of store deliveries, and carton ship to store has cost driver of number of cartons shipped. And the last one, stocking of customer store shelf, has a cost driver of hours of shelf stocking. Okay. Each customer orders consists of one or more line items. A line item represents a single product. Each product line item is delivered in one or more separate carton. Each store delivery entails the delivery of one or more carton of products to a customer. Then PharmaHelp staff stacks carton directly into display shelves in customer stores. Currently, there is no additional charge to the customers for shelf stocking, and not all customers use PharmaHelp for this activity. Okay. So we are given the level of each activity in the 3 market segments. Okay. So here we are given the activity level for each 3 market segments based on each activity area, activity area here. Now we are asked here, first compute the 2017 gross margin percentage for each of PharmaHelp's 3 market segments. Okay, so number 1 is pretty simple. We already have the data for gross margin, right? All we need to do is convert this into percentage. Okay, problem 4. So here we've copy pasted the data here, and easy enough. All we need to do is convert this 108,000 into percentage, or convert the values of the gross margin into percentage. Remember, gross margin percentage is just gross margin divided by total revenue. In this case, for general supermarket chain is 2.91%, drugstore is 4.76%, and mom and pop single stores for 9.09%. Okay, and this will be the average gross margin. All right, so that's number 1, simply enough. Then the next one is number 2. Compute the cost driver rates for each of the 5 activity areas. Okay, so here we need to compute the cost driver rate. So exactly how do we compute cost driver rate? Well, simply enough, the formula for cost driver rate is just the total cost of that cost driver, divided by the quantity of that cost driver, total quantity of that cost driver. In this case, both information is already provided here. So let's say orders processed has a total cost of 80,000. Then we just need to divide this 80,000 with the total quantity of this orders processed, which is 140 plus 360 plus 1,500, which is 2,000. So 80,000 divided by 2,000 will be the cost driver per rate, or cost driver rate for orders processed. Yes, in this case, as we can see, it's $40, or 80,000 divided by 2,000. So we just need to repeat the process for the other areas, activity areas, which is, let's say, line items orders 63,840 divided by the total of 15,000 plus 4,320 plus 1,960, which if we calculate, we'll get $3. Then for store delivery, we'll get $47,973. And then for carton ship, we'll get $1. And for shelf stocking, we'll get $16. Okay. Right. Next one here. Oh, sorry, this is, let's see here, 71,000 divided by divided by 1 for 80. Yeah, all right, same. Okay, 47.973. Okay, right. So next, so that's how we compute cost driver rates, or that's how we get number 2. So this is the answer for number 2. Right. Next, we'll go to number 3. Use the activity-based costing information to allocate the 301,080 of other operating costs to each of the market segments. Compute the operating income for each market segments. All right. So we're asked to find the operating income of each segment and to allocate the operating cost to each segment as well. So first, we need to allocate the operating cost to each segment, right? Exactly how do we do that? Well, we've divided activities into 5 activities area, right? Now, all we need to do is just multiply the cost driver rate, the cost driver rate we get from number 2, with the activity level from each marketing segments for each activity. So let's say general supermarket chains has an activity level of 140 for orders processed, right? Okay, so all we need to do is just multiply 140 by the cost driver rate of order processing, which is $40. So 140 times $40 is 5,600. And then we do the same thing for all other segments for each activity area. For example, drugstore chains for line item ordering. Drugstore chains uses 4,320 activity levels, right? For line items ordered. So all we just need to do is just 4,320 multiplied by the cost driver rate of line item ordering, which is $3, and we'll get 12,960. So all we need to do is just repeat the whole process for everything, and we'll get the total cost allocated for each segment. Okay, so as we can see, this is the cost allocated. So general supermarket chain is allocated 58,000, drugstore chain 71,000, and mom and pop single store is 170,000. Once again, if you total it, make sure the amount is the same as the total operating cost. In this case, it is the same, which is $301,080. Okay, so after we have the operating cost allocated, we can find the operating income for each market segment. So how do we find the operating income? All we need to do is just complete the table here. Since we already have this table, all we need to do is just input the operating cost, which is the answer we find before, and we can calculate the operating income for each market segment. So if we copy paste it, here we go. We'll get an operating income of 49,000 for general supermarket chains, 78,000 for drugstore chains, and 9,000 for mom and pop single stores. So this is the operating income for each segment. Remember, this is the answer from the above question. Okay, so we find the operating income, then we can calculate the operating income margin, or operating income divided by revenues. Here, 1.32%, 2.49%, and 0.48%. Now, so that's the answer for number 3, right? Now, number 4 here, comment on the result. What new insights are available? All right, so here we are asked to comment on the results. So what we need to do to comment on the result is to compare the results we get after activity-based costing with the results we get before activity-based costing. So before activity-based costing, we use gross margin percentage, right? So all we need to do is like find the data for gross margin percentage, and we compare it to the data we get using operating income, or after we use activity-based costing. Okay, so here we can see that unlike previous results, drugstore chains has the most contribution, you can say, or has the highest margin, whereas mom and pop single stores has the lowest margin. Although before using activity-based costing, we see that mom and pop single store has the highest margin. Okay, so this is the answer. As we can see, it highlights how the mom and pop single stores use a larger amount of pharma health resources per revenue dollar than the other 2 markets. Yeah, this is all right. This is the complete answers here. Then here we can highlight or give some recommendations on what pharma help should consider. In this case, pharma help could consider including choosing the appropriate cost drivers, developing a reliable database, and decide how to handle costs that may be common across several activities, as well as to make sure we account for behavioral factors. Okay, so that's practically on what to do when we comment on the result. But yeah, mainly you guys just need to highlight that in fact, mom and pop single stores uses more resources than what it seems to be, as we can see here. Okay, right, now we'll go to activity management or problem 5. Okay, so problem 5 here. Maquina company produces custom-made machine parts. Okay, Maquina recently has implemented ABM system with the objective of reducing costs. Maquina has begun analyzing each activity to determine ways to increase its efficiency. Setting up equipment was among the first group of activities to be carefully studied. The study revealed that setup hours was a good driver for the activity. During the last year, the company incurred fixed setup costs of 4,000 salaries of 14 employees, and the fixed cost provides a capacity of 28,000 hours, while the setup activity was viewed as necessary, and the value-added standard was set at 2,000 hours. Actual setup hours used in the most recent period were 26,200. Okay, right. So we are required here to calculate the volume and unused capacity variance for the setup activity, to prepare a report that presents value-added, non-value-added, and actual cost for setup. Explain why highlighting the non-value-added cost is important. 3, assume that management is able to reduce the demand for the setup activity so that the actual needed drop from 26,200 to 4,000. What actions should now be taken regarding activity capacity management? And 4, another activity studied was inspection of supplier materials and components. Explain why inspecting incoming goods should be viewed as a non-value-added activity. In providing your explanation, consider the following counter-argument. Inspecting incoming goods adds value because it reduces the demand for other unnecessary activities such as rework, reordering, and warranty work. Okay, wait, sorry. All right, so first we are asked to calculate the volume and unused capacity variance. Okay, right. So before we can find that, we'll need to know the standard price for the employees, or for the employees here. So exactly how do we find the standard price? Easily enough, we already know the total fixed setup cost. All we need to do is divide the fixed setup cost with the capacity. 504,000 divided by 28,000 hours. Then we'll be able to get our standard price here. And then we'll have standard quantity, or the quantity needed for set added value. Quantity needed. Okay, here we go. Then we'll have the AQ, or capacity, quantity, capacity, quantity. Then this actual capacity used. Okay, so what exactly are these variants? These variances are practically the differences we get, or the deviations we get from the normal capacity to the needed capacity, which is practically 2,000, right? So we'll see first, okay, right? So this is the dollar amount of the value added activity that is actually needed. So we actually only need to spend 36,000 for value added activity, which is the standard price multiplied by the hours needed for added value, right? So we actually only need 36,000 for value added activity. However, we incurred an actual cost of 504,000. This is actual cost is what we get from the data here. Where is it? Yeah, 504,000 is the actual cost. Now, the difference between the actual cost and value-added activity, or the cost needed to get value-added activity, is the non-value-added or volume variance. So simply 504,000 minus 36,000. Sorry. Okay. Now, aside from the actual cost, this is okay. Now, aside from the actual cost, we'll also need to calculate the used cost, or the cost which is actually used if we calculate this. So if we actually calculate the cost based on what we used only, which is 26,200 multiplied by the standard price, we'll get a cost of 471,600. Now, this would be the unused capacity variance, which is practically the cost incurred to capacity which we actually do not use. Right, so that's the answer for the first number, which is the volume and unused capacity variance. Okay, next, number 2, prepare a report that presents value added, non-value added, and actual cost for setup. Okay, sorry. All right, so here, all we need to do is just highlight the ones we got before. So we actually only need 36,000 for value added. And then we actually need 468,000, or this is the non-value added, or the cost we incurred for activity that actually does not give value added. And this is the actual cost. Now, here we are asked why highlighting non-value added cost is important. All right, so in activity-based management or in cost accounting in itself, highlighting non-value added cost is important because we have the goal to reduce costs, right? Now, usually we reduce cost by reducing the non-value added cost. Why? Because non-value added cost does not actually add any value to our customers. So it does not increase the customer value. So it's cost which we could eliminate, or we should aim to reduce or eliminate. Okay, that's number 2. Next is number 3. Assume that management is able to reduce the demand for the setup activity so that the actual hours needed drop for 26,200 to 4,000. What actions should now be taken regarding activity capacity management? Okay, so here we can say that they're able to reduce the setup activity required from 26,200, which is what we used before, to 4,000 hours. So right here, remember that one employee can get 2,000 hours. So in actual cost condition, we need 14 hours to get the 28,000 setup capacity, right? While in actual use, or in practice, we also still need 14 employee because 26,200 hours requires at least above 13 employees, right? Now, however, when we reduce the setup activity from 26,200 to 4,000, all we need is 2 employees. Now, what this means is that we can reduce the cost of the other employees by, let's say, laying them off, since we only need 2 employees, right? So what this means is that we can reduce the cost by 12 employees times 2,000 hours times $18 per hour. It's 432,000. Okay. So that's the implications for number 3. Next, number 4. The activity studied was inspection of supplier materials and components. Explain why inspecting incumbent goods should be viewed as non-value activity. All right. So inspection itself is non-value because, once again, remember the definition of value-added activity is an activity which increases the customer's value or the product's customer's value. Now, however, inspection does not increase the customer value logically or intuitively, since we actually do not, right? So technically, inspection is non-value added activity. Now, if we're given the argument activities, we can also say that technically, if our supplier is goods, our supplier is of high quality, then we actually don't need inspection because, yeah, we already trust the supplier and they already supply good material components. Okay, so that wraps up for activity-based costing and activity-based management. Maybe to sum it all up, activity-based costing is simply simple costing. However, we just make it more specific, or we divide it into more activity areas, like this case. Whereas, let's say for simple costing, we tend to use only one cost driver rate. Instead of many here. While for activity-based management, well, it's usually theoretical, so maybe you guys can read the book as well. But it tends to ask us about how or what we can do with the information given from the activity-based costing. Okay, right. So that goes for activity-based costing and activity-based management. Next, we're going to quality cost. All right, so quality cost is more theoretical, where in practice or in essence, the theories you guys need to remember is practically on how to categorize the cost or the cost of quality. Okay, so I'll just mention a little bit about it. So cost of quality is practically costs incurred to prevent the production of low quality products or results from the low quality products produced. Now, cost of quality itself can be divided into 4 categories, which you guys will need to remember. There will be prevention. Prevention is practically costs we incur to prevent the production of low quality products or to prevent any defects. Then appraisal. Appraisal is practically the costs we use to identify if there are any defects. And then internal failure. Internal failure is the cost we incur if we find the cost we incur on defects before they are shipped out to customers, which is why internal. So this is the cost if there's any failure before we ship it out to the customers. And then the last one is external failure, which is the cost incurred on defect after they have been shipped out, or practically the cost incurred on defect products once they ship to the customers. Now, since this is mostly theory, what you guys need to remember is practically what is considered prevention, what is considered appraisal, what is considered internal failure, and what is considered external failure. So the book has it on the balance scorecard chapter, but here I took a little bit of a picture on what is normally considered. So you guys probably will need to remember this so you can remember which category they are on. Which category they are on. So here are some common examples. Prevention includes design engineering, process engineering, supplier evaluation, preventive equipment maintenance, quality training, and test materials. While appraisals like inspection, online product manufacturing and process inspection, and product testing. Right. Now, while internal failure cost includes spoilage, rework, scrap, machine repairs, manufacturing process engineering on internal failures. While external failure includes customer support, manufacturing process or engineering for external failures, warranty repair cost, and liability claims. So these are some common examples. All right, since we've heard about that, let's just go straight forward to the problem itself. Problem 6, costs. During 2007 and 2008, Norton Company reported sales of 18 million per year. Norton listed the following quality costs for the past 2 years. Assume that all changes in the quality cost are due to a quality improvement program. Okay, so here we are stated or asked to assume that the difference in the cost of quality from 2007 to 2008 are due to a quality improvement program. Okay. So first we are asked prepare a quality cost report for each year. Okay. Next, how much were the additional resources invested in prevention and appraisal activity from 1 year to the next, and what return this investment generate? Okay. And the last one is the management of Norton believe that it is possible to reduce quality cost to 2.5% of sales. Assuming sales continue at 18 million level, calculate the additional profit potential facing Norton. Is the expectation of improving quality and reducing quality cost to 2.5% of sales realistic? All right. So first, we need to prepare a quality cost report. So what exactly is quality cost report? Well, a quality cost report is similar to the one given here, except that we need to categorize each activity based on each category of quality cost. So like I mentioned, what we need to do is drag or categorize this based on which one are prevention, which ones are appraisal, which ones are internal failure, and which ones are external failure. Okay, so in this case here, we can categorize, let's say the first one, field trials. Okay, so field trials can be considered as prevention costs. Then next, quality training here. Quality training is here also as well. Quality training is prevention costs as well. Then next we have recalls. Recalls are practically when the customer asks back or practically send back the product. So recalls are included as external failure. Then the reinspection occurs if there's a, let's say, defect and we need to inspect it again. So reinspection is internal failure. Then we have packaging inspection. Packaging inspection is like a normal inspection except for packaging. So it's considered as appraisal cost. Then since quality training already, process acceptance. All right. So process acceptance is appraisal cost as well. It's here, it's not here, but you guys will probably need to remember this. And then there will be retesting since there's a re before the testing. So we know it's testing after a defect occur. So this is internal failure. And then lost sales, yeah. Lost sales practically when the customer does not want to buy it, or practically we lost sales because the customer received defect products. So it's external failure. And complaint adjustment, which is, since it relates to the customer as well, it's external failure as well. Okay, so in a quality of cost report, what we need to do is just categorize them and add their costs up. Here, all we need to do is input the cost of each activity, which is already provided here. 450,000, 120,000, 180,000, 150,000, 300,000, 435,000, and so on, which we will total or sum up to get 3,600,000. Remember, it must be the same with the one given here. Then, aside from that, in a quality cost report, we would also need to calculate the total cost to the percentage of sales. In this case, we need to divide the percentage of sales from each quality or cost of quality category to compare it. Let's say, for example, prevention cost has a total cost of 570,000, whereas the sales on 2007 is 18 million. So we need to know the percentage of 570,000 divided by 18 million, which is 3.17%, and so on. And then we'll get a quality cost report like this here. Now, that's only for 2007. Here we're asked to make 2008 as well. So no difference. We just need to do the same thing, and we'll get this result here. Remember, make sure that the total quality cost is the same as the question, which is 3 million. Okay, so that's practically for number one. So all we need to do for number one is just categorize them based on their category and find the percentage of sales of the quality costs in proportion to the revenue or sales. Right, sorry. Now, number two, how much were the additional resources invested in prevention and appraisal activity? So all we need to do is compare the prevention and appraisal here. We can compare this. So in the first year, or in 2007, prevention cost is 570, whereas in the second year, 1,200,000, which is 630,000 more. And then for appraisal, it goes up from 330 to 360, or 30,000 more. So in total, it has a 660,000 rise in prevention and appraisal costs, right? As you can see here. So control costs increased by 660,000, which is the answer to the first question. Next, it goes, what return did this investment generate? To find the return, we need to know the reduction in the failure cost. So once again, all we need to do is just compare it. Here, in the first year, we have a total of 735 plus 1,965,000 failure costs, or 2,700,000. Whereas in the second year, or 2008, we have a total of 1,185,000 plus 255,000, or a total of 1,440,000. So we minus the cost during the first year with the second year, and we get that the cost is reduced by 1,260,000. Okay, so we're practically asked what return did this investment generate? So the return generated is 1,260,000. So for 660,000 investment, we managed to reduce cost by 1,260,000. Okay, that's for number 2. Next, we go to number 3. The management of Norton believes that it is possible to reduce quality cost to 2.5% of sales. Assuming sales continue at the $18 million level, calculate the additional profit potential facing Norton. Is the expectation of improving quality and reducing quality costs to 2.5% of sales realistic? Okay, so in here, all we need to do is just find the quantity or the amount if the quality cost is only 2.5% of sales. So how do we do that? Simply, our sales is 18 million, right? All we need to do is find 2.5% of 18 million, which will be, which will be 400, this is 450,000, okay. 450,000, which we will need to reduce from our original quality cost. Now our original quality cost, as we can see here, is 16.67%. Here, okay. So all we need to do is 16.67%, 80 million times 16.67%. Right, and we'll reduce this to here. Right, and this will be our answer, which is, this is 2,550,600. So we'll be able to reduce costs by 2,550,600. Since this is our original level, original sales of percentage quality cost level. And this is our goal. Yeah, goal. So if we manage to achieve our goal from our original state, we'll be able to reduce costs by 2,550,600. Now, the next question is asking whether the expectation is realistic. Since this is theoretical, the answer is yes. So as a rule of thumb, 2.5% is actually realistic, or 2.5% percentage of sales for quality cost is actually realistic, since it's usually obtained in the real world as well. So real world companies have obtained 2.5% as well. So the answer is just yes, it's realistic. Okay, so that's all for quality cost. So practically what you guys need to remember is how to classify each activity and finding the percentage of sales. That's mostly it for quality cost. Right. Next, we'll go to JIT, inventory management, and backflash costing. Right. So I'll explain a little theory on inventory management, JIT, and simplified costing. Okay. So what exactly is inventory management? So inventory management is the planning, coordinating, and controlling flow of inventory. That's inventory management. Now, the costs we'll need to remember in inventory management is usually purchasing costs, ordering costs, carrying costs, stock out costs, and the cost of quality. Right. Now, in inventory management, there will be a few concepts that we'll need to remember. The first is EOQ, or economic order quantity, which is practically a formula to give us the optimal order quantity. So the formula is simply Q equals to the square root of 2 times demand for a specified period times the ordering cost divided by the carrying cost. That's EOQ. We'll see it in implementation later. The next, another concept to remember is reorder point. So reorder point is practically at which point or at which quantity of goods in the inventory we have left do we need to order. So reorder point has the formula of number of units sold multiplied by the purchase order lead time. So that's reorder point, which we will see later also. Then another concept is safety stock. Safety stock is practically inventory held at all times, regardless of the quantity ordered. To calculate the optimal safety stock in cost accounting, or in this context, we'll need to find the total relevant costs in having that amount of safety stock, which we will find through a table, which we will see later in practice or in this question. Next is JIT. JIT is the short term or acronym for just in time. So there are two different types, right? JIT purchasing and JIT production, but they're practically the same principle. So JIT purchasing is purchase of materials so that they are delivered just as needed or just in time. Whereas JIT production is the production of products only when it is needed. So that's JIT. So JIT is a little bit different compared to traditional ones, where traditional one, we tend to still hold inventory, right? But in JIT, all we need to do is we produce or we purchase only when we need it or only when there's demand for it. So that's inventory management and JIT. Next, we have backflash costing. So what exactly is backflash costing? Backflash costing is practically the simplification of journal entries. How is it like? Okay, so normally a journal entry in a manufacturing firm or in production process has 4 stages, or it can be divided into 4 stages. The first stage is the purchase of direct material and conversion costs. Usually in that stage, the journals would be material inventory debited and account payable credited. And then conversion costs controlled debited and various accounts credited. That's for the first stage. This is mostly theoretical, so you guys will probably have to remember this. Or if you can remember it intuitively, that's great as well. The next stage is stage B, or the production of work in process inventory. So in stage B, the journal entries are usually just debit WIP control and credit materials inventory and conversion costs allocated. That's for stage B. Next is the third stage, or stage C, which is the production of finished goods. In stage C, all you need to do is usually just debit finished goods control and credit WIP control. And then next, for the last stage, stage D, which is the sales of the product. In stage D, usually what the journal entries we write is debit cost of goods sold, and then credit finished goods control, and then we debit conversion costs allocated, and we credit conversion cost control, and we either debit or credit cost of goods sold based on the conversion costs under allocated or over allocated. Now in backflash costing, what we do is we reduce some of the stages. So for example, in backflash costing, we would like to remove stage B to simplify the journal entries. Later we can see some of the examples in the problem later. But the point is, in backflash costing, what we do is we simplify the journal entries by removing some journal, or by removing some of the stages. Okay. So first, let's just get into the JIT one. Okay, problem 7, JIT. Chadwick Shoe Co. produces and sells an excellent quality walking shoe. After production, the shoes are distributed to 20 warehouses around the country. Each warehouse services approximately 100 stores in the region. Chadwick uses an AOQ model to determine the number of pairs of shoes to order for each warehouse from the factory. Okay, annual demand for warehouse or 2 is approximately 120,000 pair of shoes. Ordering cost is 250, and annual carrying cost is 2.50 per pair, 2.40 per pair. Sorry. These will be some important information. The next two questions are: what is the EOQ model to determine the optimal number of pairs of shoes per order? 2, assume each month consists of approximately 4 weeks. If it takes 1 week to receive an order, at what point should warehouse OR2 reorder shoes? 3. Although OR2's average weekly demand is 2,500 pair of shoes, demand each week may vary with the following probability distribution. Okay, here we're given this for number 3. If a store wants shoes and OR2 has none in stock, OR2 can rush them to the store at an additional cost of $2 per pair, this is the stock out cost. How much safety stock should warehouse OR2 hold? How will this affect the reorder point and reorder quantity? Okay, so this problem 7, let's tackle it one by one. First, we are asked to use the EOQ model to determine the optimal number of pairs of shoes per order. Okay, when it comes to the EOQ model, all we need to do is just follow the formula. Remember, the formula is Q or EOQ equals to the square root of 2 times demand for that specified period times the ordering cost divided by the carrying cost. In this case, it is the square root of 2 times the demand, which is 120,000, times by the purchasing cost, 250, divided by the carrying cost per product or per unit, which is 2.4. Then we get EOQ equals to 5,000. So that's simply number 1. For the EOQ, all you need to do is just input the formula. Next is number 2. Assume each month, blah, 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 if it takes 1 week, at what point should warehouse OR2 reorder shoes? Okay, so here we are asked the reorder point. So the reorder point is simply, or the formula for reorder point is simply number of units demanded per time period multiplied by the purchase order lead time. Okay, here. Now, so which means we need to find these 2 factors first, right? So first, what we can do is find the number of units demanded per time period. Now, how exactly do we know what time period it is? Well, in the reorder point, the time period equals to the purchase order lead time. All right, so here we know that the purchasing lead time is 1 week, as given by the question. Where is it? Takes 1 week to receive, yeah, order. That means the number of units demanded per period is equal to the number of units demanded per week, or the time period used is week. So all we need to do is find the weekly demand. Easy enough, weekly demand is just annual demand divided by the number of weeks. Okay, in this case, we have a monthly demand of 10,000 divided by 4. Okay, how do we get 10,000? Simply 120,000 divided by 12, since there are 12 months in a year. Okay, so 10,000 divided by 4, 2,500. And so we have 2,500 and 1 week. Then all we need to do is follow the formula. So 2,500 multiplied by 1, which is 2,500. So the answer is 2,500. So what this means is that it is best for us to reorder the shoes when we only have 2,500 pairs of shoes in the inventory left. So that's number 2. All right, next is number 3. So in number 3, we are given a situation table with our probability table, and we are asked how much safety stock should warehouse OR2 hold. So once again, if you want to find the optimal amount of safety stock, we need to calculate the relevant total cost. So what exactly is relevant total cost? Relevant total cost is practically the relevant carrying cost plus the expected stock out cost plus the relevant order cost. Okay. So first, we need to divide these scenarios, or divide this thing into 3 different scenarios. Now, to make it simpler, since the table gives us scenarios for every scenario or every difference in 250 pairs of shoes, then use that as a basis or as a benchmark. In this case, we make scenarios in which we have safety stock of 0, safety stock of 150, or safety stock of 500. All right. So we note here. Then let's start first with the safety stock, or with the scenario where we have 0 safety stock. If we have a 0 safety stock, that means we will hold 2,500 pairs of shoes, right? How do we know 2,500? It's based on our reordering point. Sorry, we will hold 2,500 pairs of shoes. And that means we will occur, or stock out will occur if the demand rises above 2,500. In this table given, we know that demand could be above 2,500. Oh, yeah, in this case, it could be 2,750 or 3,000. So here, there are two possibilities in which stock out will occur. First, if the demand is 2,750, and second, if the demand is 3,000. If it does happen, we will have a stock out as much as 250 units and 500 units. Now, what we need to do to find the relevant stock out cost is to multiply the stock out cost with the stock out units with the probability of the scenario happening. In this case, let's say the probability of the demand being 2,750 is 0.2. So we multiply 0.2 with 250 with the stock out cost, which is $2, and we'll get 500. And then, oh, sorry, this is relevant stock out cost. And we'll get 2,400. Oh, I'm sorry, we also need to multiply it by the number of orders. I almost forgot. So practically 250 times 0.2. And then we multiply it by the number of orders as well. And then we multiply it by the stock out cost. Okay. And then here we'll get a total of 2,400 here. Then next, we do the same thing for the scenario where if the demand is 3,000. So if the demand is 3,000, the possibility is that we'll get a stock out of 500 units since we only hold 2,500. And the probability of stock out is 0.04. So all we need to do, once again, is multiply $2 times by $500 units, multiplied by the probability of stock out, multiplied by the number of orders per year. And we'll get the expected stock out cost, which is 960. Okay. And then once we find the expected stock out cost, we add them up since they're both in the scenario in which we only hold 0 safety stock. So if we hold 0 safety stock, we can have an expected stock out cost of 3,360. So how about the relevant carry cost? Well, if we hold 0 safety stock, we don't incur any additional carrying costs, right? So the relevant carrying cost is 0. And since if our safety stock is 0, the number of orders stay the same, so we don't add any relevant ordering costs. So our relevant total cost, if our safety stock is 0, will be 3,360. Next, we go to the next scenario. If we increase our safety stock to 250, if our safety stock is 250, we will hold 2,715 inventory, right? Now, so from this, we know that the only possible chance of us getting stock out is if the demand is 3,000. In this case, if the demand level is 3,000, we will have 250 units stock out, since 2,750 minus 3,000. And the probability is 0.04. So once again, we need to calculate the expected stock out cost, which is the expected stock out in units, 250, multiplied by the stock out cost, $2, multiplied by the probability of the chance of the stock out happening, 0.04, multiplied by the number of orders per year, and we'll get 480. Now, unlike before, we'll have relevant carrying costs. Why? Because we carry an extra 250 units, right? So all we need to do is just multiply the carrying cost by the safety stock or the units of safety stock we put, which is $2.4 times by 250, which is 600. And then we sum them up and we'll get a relevant total cost of 1,080. Then same thing goes for the safety stock if it's 500 units. So if our safety stock is 500 units, there is no chance of us having a stock out, right? Because the maximum demand is 3,000 here, as we see at the table. So our expected stock out cost is 0. However, we will have relevant carrying costs. In this case, 500 multiplied by the carrying cost per unit, 2.4, which we will get 1,200. Now, how exactly do we choose which optimal level of safety stock? We choose the relevant cost or the least or the most smallest relevant cost. Choose the smallest relevant cost. So in this case, the smallest relevant cost is when the safety stock is 250. That means, yeah, our optimal safety stock will be 250 here. Therefore, warehouse or 2 should hold a safety stock of 250 pairs. So that's the answer for the first question. Next, we are asked, how will this affect the reorder point and reorder quantity? Okay, so for the reorder quantity, just remember the reorder quantity won't be affected by safety stock. So reorder quantity is unaffected by safety stock. However, the reorder point will be affected by the safety stock. So the new reorder point will be the old reorder point plus the optimal safety stock we chose. In this case, the old reorder point is 2,500 as our answer before. And then the optimal level of safety stock we chose is 250. So 2,500 plus 250, and we'll get 2,750 pairs. Okay, so that's the answer for problem 7. Next, we'll go to problem 8, which is backflash costing. Right? So let's just go straight to the problem. Grand Devices Corporation assembles handheld computers that have scaled-down capabilities of laptop computers. Each handheld computer takes 6 hours to assemble. Grand Device uses a JIT production system and a backflash costing system with 3 trigger points. Okay, purchase of direct materials and conversion cost incurred, completion of good finished units of product, and sales of finished goods. Okay, so what we know here is that Grand Devices only use 3 stages, unlike normal costing or normal methods. So as we can see, this lacks the production of WIP, work in process stage, or lacks the trigger point. Yeah, this is trigger point or trigger point. Right. So what we do know is that they simplify their journal entries by not inputting the stage of the production of WIP. Okay, next one. There are no beginning inventories of materials or finished goods and no beginning or ending work in process inventory. Okay. Then we are given the following data: direct materials purchased, direct materials used, conversion cost incurred, and conversion cost allocated. Right, sorry. Next one. Grand Device records direct material purchase and conversion incurred at actual cost. Has no direct material variances. Then when finished goods are sold, the backflash costing system pulls through standard direct material costs and standard conversion costs. And here it said Grand Device produced 28,800 finished units in August 2017 and sold 28,400 units. Okay. Then the actual direct material cost per unit in August 2017 was $102, and the actual conversion cost per unit was $27. All right. So our first question is prepare summary journal entries for August 2017 without disposing of under or over allocated conversion costs. All right. So our first, excuse me. Right. Right. So our first question is to prepare summary journal entries for August 2017. Okay. Here we can see that they only use 3 trigger points, right? So all we need to do is just record journal entries for those 3 trigger points. So the first one is record purchase of direct materials, which is materials and in process inventory control debited and credited accounts payable control. By the amount here, by the amount purchased, yeah, remember this purchase. So 2,958,000. Okay, now here we record conversion cost incurred as well, which is practically the first stage as well, which is there here. Conversion cost control debited and various account credited. By the amount incurred, yeah, here the amount incurred is 777,600. Okay, now next one, since we don't have stage 2, or practically since we don't have the production of WIP stage, we just go straight for completion of goods finished units. In which case, what we do is just instantly debit finished goods control, and we credit the materials and in-process inventory control used and the conversion cost allocated. So remember, this is different than the purchase, yeah? This is the one used, which we can see here, 2,937, and allocated is 806,000. Now this is different than the normal one. In the normal one, if there is stage two, what we do is after we record conversion costs, we debit or allocate material and conversion costs to work in products. And then in stage three, all we need to do is debit finished goods and credit work in process. However, since Grand devices use backflash costing, and they skip stage two, we don't use this journals. What we use is instantly finished goods control, and we credit materials and conversion costs. Okay, right. So that's for C. Then next, for the last stage, which records a finished goods sold, is simply just cost of goods sold, debit, and finished goods control credited by the amount sold. Yeah. As we can see here, it sold 28,400 units. So all we need to do is 28,400 divided by 28,800 multiplied by the finished goods control, and we will get the amount allocated to cost of goods sold. Or we can do it like this: 8,400, 8,800 multiplied by 3. Yes, which will be 3,692,000. And then our ending inventory will be 52,000, or simply, 3,744 minus 3,692. Now here it is said without disposing of under or over allocated conversion costs. Since we don't need to dispose it, all we need to do is just end it there, yeah. Later we'll see what happens if we dispose it. Okay, so that's for question 1. Question 2. Post the entries in requirement 1 to T accounts, okay, for applicable materials and in-process inventory control, blah, blah, blah. All right, so this is just normal posting. So all what we need to do is just make the T accounts for each account, and we just post the journal entries we did to the T accounts. If we did that, this will be the answer. That's number 2. So this is practically normal T accounts or normal ledger. Then number 3, under an ideal JIT production system, how would the amounts in your journal entries differ from those in requirement 1? Okay, so it's as under an ideal JIT system, right? Now remember, JIT is just in time, where we don't hold any inventory, where we just purchase or produce inventory when it is demanded. So under an ideal JIT product system, we won't have any inventory. There will be 0 inventories. What this means is that entry C would have the same amount as the cost of goods sold, and there will be no inventory for direct materials. Because like, as you can see, if the cost of goods sold is not equal to the finished goods, we will have ending inventory, right? But under an ideal JIT system, there will be no ending inventory. So the cost of goods sold would have been equal to the finished goods control. And that there will be no inventory of direct materials as well, since we only purchase when we need to, under an ideal JIT production system, yeah. However, yeah, real-life application is usually not ideal. Okay, that's for 8A. Now for 8B. Assume the same facts as in problem 1, except that Grand Devices now uses a Backflash Costing system with the following 2 trigger points for making entries in the accounting system. The first one is purchase of direct material good, and the second one is sales of finished goods. Okay, so this time, unlike previous, we only have 2 trigger points. So what this means is that they skip stage 2, and stage 3. So this one before skip stage 2, right? As we can see. However, this time, this one skips stage 2. However, this time we also skip the completion of finished goods. So we only have purchase of direct materials and sales. Okay, Here's mentioned the inventory control will include direct materials purchased but not yet in production, materials work in process, and materials in finished goods but not sold. Then no conversion costs are inventory. Any under over allocated conversion costs are written off monthly to cost of goods sold. Okay, so remember before UTS we learned about dumping or throwing our under or over allocated conversion costs, right? In this case, we're just asked to write it off to cost of goods sold. Okay, so the first one is prepare summary journal entries for August, including the disposition of under or allocated conversion costs. Okay, right. So this will be the answer for 8B. So the first one, since we only have two stages, we only need to first record the purchase of direct material, just debit material and in-process inventory and credit accounts payable. Now we also need to record conversion costs incurred like before, debit conversion costs and credit various accounts. If you see, it's the same amount because yeah, it's practically the same thing. So with the same amount as before. However, this time we don't record any cost of goods finished unit completed because we don't consider this as a trigger point anymore. Now, however, what we do is when we record finished goods sold, what we do is we debit cost of goods sold and credit it directly to the materials and in-process inventory and conversion cost. So that's what we do. Then we'll get this amount, 3,692,000 and 2,896,800. Where do we get this from? Well, simply 24,000, sorry, 24,400 divided by 24,800, or the amount sold divided by the amount produced here, 28,400 divided by 28,800, sorry, here, multiplied by the direct materials we purchased. Multiplied this. Yeah, this is a bit different, sorry. Transaction process. Sorry. Is there a question? Yeah. Okay. Since this one actual direct 102. Yeah. Okay. Sorry. In principle, it should be like that. So this should be 291,000. Then the conversion cost allocated. It's also the same thing. So all we need to do is just here. Where's conversion cost allocated? 806,400. Oh, sorry. I multiplied the wrong thing for it. This is multiplied by 293,7,600, right? Right, sorry. Remember, we're gonna use direct materials used, yeah, since this used, not purchased, right? And then for conversion cost allocated, same thing. So we just use the ratio 28,400 sold divided by 28,800 produced, multiplied by the conversion cost allocated, which is 806,400. 806,400. Yeah, and we'll get this amount. And all we need to do is just credit this and debit cost of goods sold. Now here, unlike before, we are asked to dump or to dispose the under or over allocated conversion cost to cost of goods sold. Okay, so simply all we need to do is just make a journal for it. In this case, we can see that conversion cost allocated is higher than conversion cost control. So we know this is over allocated, yeah. Okay, so when it's over allocated, all we need to do is reduce cost of goods sold. So all we need to do is just credit cost of goods sold or reduce it by the amount over allocated. The amount over allocated is simply 795,000 minus the 777,000, which is 17,600. Okay, so that will be the journal entry, or that will be what happens if we dispose the under or over allocated conversion costs. If, for example, the previous number disposes it as well, it'll be the same journal call. It's literally the same. If we're asked, yeah, this will be conversion costs. Oh yeah. This will be cost of goods sold and conversion. Oh, sorry, conversion cost allocated by control. So it'll be the same thing here, and then here, and then this will be 17,600, and this will be the difference. Yeah, okay. Right. All right. Now, next we'll go to the next question. Post the entries in requirement 1 to the accounts. Okay, so practically the same thing as we did before. All we need to do is just make the T accounts for each account, and then we just post the amount from the journals. And you'll get the answer like this here. All right, so that will be all. Before I close for the backflash costing, this is mostly, to be honest, theoretical, and so you guys will probably need to remember it. However, the book is already complete, so yeah, the book will tell you like what kind of journals should you make if there are only, let's say, 2 trigger points, or if there are only 3 trigger points. This is an example of one of them. So yeah, normally we would have four stages, right? Or in normal, this is the normal, let's say normal method, we will have 4 stages. However, let's say if we use backflash costing and we erase stage 2, stage B, then the accounts made will be like this. Yeah, you guys can just further read the book. So practically backflash costing is the simplification of journal entries by practically not journaling some of the stages in the production. Okay, so that's practically everything. So maybe to sum it all up, I'll give a quick review. All right, so the important thing in joint costs and byproducts is that joint costs can be allocated to through 4 different methods actually. The first one, remember, sales value at split off. The second one is net realizable value. And then there will be a third one, which is constant gross margin. In that case, all you guys need to do is just make sure that the gross margin for each product is the same. And then you guys will allocate the joint cost based on that. And the last one is physical measure method. Now remember, the only difference between them is their weighting, yeah? And their basis of the weightings. That's practically the essence for joint costs. And then for byproducts, remember byproducts, there are 2 methods, production method and sales method. The only difference is that in production method, is this the question? No, this is, yeah, right. In production method, we recognize byproducts during production. And we reduce cost of goods sold, or the work in process inventory, or joint cost allocated, sorry. We reduce the joint cost allocated or work in process inventory by the net realizable value of the byproduct. Here we can see it, it's reduced here. However, we don't recognize byproducts, or we don't recognize the sale of byproducts as revenue. As you can see here, there's no revenue here. We just credit it or reduce it by the inventory of the byproducts. Then next, there will be the sales method. Sales method, we don't recognize byproducts at time of production, but we recognize the byproducts during sales, and we recognize sales revenue when the byproducts is sold. That's the difference between production method and sales method. Okay, then the essence for cost allocation. The essence for cost allocation is usually the support departments. Remember, the thing to remember is that there are 3 methods: direct method, step-down method, and reciprocal method. Once again, remember, in the direct method, you only allocate to operating departments. So only the operating departments is considered in the direct method. In the step-down method, you allocate the cost of one supporting department to another supporting department and the operating departments, but you only do it once, or you only do it sequentially. So like, let's say if we allocate A first, we allocate the cost of A to B as well, to supporting department B, and to X and Y, right? However, we do not allocate the cost of B to A. That's step down. And if it's B first, yeah, we allocate the cost of B to A, but we don't allocate A to B. However, in reciprocal method, this is usually the most detailed and accurate one. We allocate all the costs from each supporting departments to other supporting departments as well. So practically we bounce them back and forth. So we allocate A to B, right? And then B is allocated to A again. And then once we know we have more costs at A, we allocate the cost at A to B, X, and Y again, right? Then once we know there are still costs left at B, we allocate it again to A, X, and Y, and so on until both it's 0. And we find the value for X and Y. Okay, so that's practically for joint costs or cost allocation, sorry. That's for cost allocation, not joint costs, right? Next, for activity-based costing, in essence, is practically simple costing, but it's more specific. In this case, you will usually have to find multiple cost driver rate, and through this multiple cost driver rate, we will allocate the operating costs or whatever cost we need to allocate on. So that's practically the essence of activity-based costing. And then next would be quality costing. The essence of quality costing is practically remembering which activities considered which. So you guys will have to read and probably memorize what activities are considered what type of cost, like is it prevention, appraisal, internal failure, or external failure. From this, once you're able to properly categorize it, you'll be able to make a quality cost report. So the important part is actually categorizing it. The calculations are usually simple, where in a quality cost report, all you need to do is usually find the percentage of cost to the sales. Then all we need to do is usually compare it from one year to the other, and we see if there are any improvements or not. So that's practically quality cost in a nutshell. Then for inventory management, some important things to remember is EOQ, remember the formula. And then remember reorder point, remember the formula as well. And then safety stock, remember to make the table. Remember to calculate the relevant total cost to find the optimal safety stock. That's for inventory management. And then that's for inventory management and JIT, sorry. Then for backflash costing, what you guys need to remember is practically the journal entries needed to make if you ignore or if you don't consider a certain stage. Right? Remember, as usual, in a normal method, we will have 4 stages. However, in backflash costing, the companies would usually only consider 3 or even 2 trigger points or stages. So you guys will need to remember the journal entries to make if they only consider 3 to 2 trigger points. Okay, so that's all. Are there any questions, maybe? Okay.
It's pretty clear, Kak.
Yeah.
Thank you.
Okay, thank you. All right, I'll stop sharing and I'll leave the rest to the panitia, yeah. That's it. Okay, thank you.